Welcome to Breaking News to Trading Moves. Today we're focused on a major corporate development. It's one that really cuts across industrials, packaging, and high finance.
That's right. We're talking about the recent announcement regarding Sealed Air.
Sealed Air, the company behind bubble wrap, of course, but also a huge supplier of food packaging and all sorts of protective materials.
And they are making an exit from the public markets.
The headline here is that Sealed Air, that's ticker SEE, is being taken private.
By funds affiliated with Clayton, Dubilier, and Rice. It's an all-cash transaction.
And the value on that?
$10.3 billion.
Okay, so for the people holding the stock right now, what does that mean?
Well, the value is locked in for them at $42.15 per share. And that was a very solid premium compared to where the stock was trading before all the rumors started.
And what about the timing? The stock is set to leave the New York Stock Exchange around mid-2026.
That's the plan, yes. Assuming all the regulatory and shareholder approvals go through.
But there's a little detail in there I want to clarify for you, the listener. It's this thing called a go-shop period.
Ah, yes. That's a pretty standard clause in these large take-private deals.
So what is it exactly?
It just means the Sealed Air board has a short window of time, maybe 30 or 45 days, to go out and actively look for other potential buyers.
To see if anyone might offer a higher price than Clayton, Dubilier, and Rice.
Exactly. It shows they've done their fiduciary duty to get the best value, though honestly, with a deal this big, it's pretty rare that a competing bid actually shows up.
Okay, so our mission today is to go beyond that press release. We're going to identify the specific companies and sectors that really stand to benefit from this deal.
And then on the flip side, the ones that are now facing new challenges, either on the cost side or, competitively, now that Sealed Air is going private.
It's a classic value chain analysis, right?
It is. Who makes money on the deal and who, down the line, starts paying for it?
Let's start with the upside then. The immediate winners. And I guess the most obvious group would be the shareholders.
Correct. Can't get more direct than that. Holders of SEE get a confirmed return. They're being cashed out at $42.15. It just removes all the risk for them.
So beyond Sealed Air itself, how does this affect the broader packaging sector? Does this give a lift to peers like, say, Packaging Corporation of America, ticker PKG?
Yes, it does. And this is where that market read-through is so important. When a huge player like Sealed Air gets bought for over $10 billion and at a premium valuation.
It validates the whole industry.
It validates the whole industry. The deal sets a new benchmark. The thinking for PKG and others is that, well, sophisticated financial buyers have just confirmed that there's strong, defensible cash flow in packaging.
So the market starts to think who's next.
Yeah.
And re-rates those stocks higher.
That's the idea. It creates a bit of momentum.
Okay, that covers the industry. Now let's turn to high finance. The huge alternative asset managers. I'm thinking Blackstone, BX, or KKR. They aren't the buyer here, so how do they win?
They benefit through signaling. And that signal translates directly into their ability to raise money.
What's the signal?
It signals a couple of things. First, that the leveraged finance markets are healthy enough to support these mega deals. And second, that industrial and packaging assets are still very much in demand.
And why does that matter so much to a Blackstone or a KKR?
It all comes down to their assets under management, their AUM. When investors see that these multi-billion-dollar buyouts are happening, it makes it so much easier for BX or KKR to go out and raise their next giant fund.
Right. They can point to this deal and say, see, the environment is active. We can put capital to work.
Precisely. And larger AUM means larger management fees, larger performance fees. It just keeps their whole business model turning.
Okay, let's get even more specific. To the deal makers themselves, the investment banks. A $10 billion transaction needs some serious advisory and financing.
Oh, absolutely. The bench for a deal like this is deep. You're going to have banks like JP Morgan, that's JPM, and Goldman Sachs, GS, all over the debt financing and advisory work.
What does this particular deal tell us about the health of the leveraged finance market?
It's a major tell. It confirms the credit markets, which are really the plumbing for all of this, are open for business again, at least for high-quality, cash-generating companies like Sealed Air.
So CD&R had to go out and raise billions in debt to fund this?
They did, likely through high-yield bonds or a syndicated loan, and if JPM and GS can successfully place that debt...
They get a big fee, obviously.
They get a big fee, yes. But it's more than that. It serves as a green light for even more deals, more take-privates, more spin-offs. It shows the risk appetite is back, which means a whole new pipeline of future revenue for those banks.
So the winners are clear. Yeah, the shareholders, the packaging peers, the big asset managers, and the banks funding it all. That's a lot of value being created on one side of the ledger.
It is, which means we have to look at the other side. Who might end up footing the bill?
Where do the challenges start to show up?
The risk, it almost always travels down the supply chain, especially when a key supplier like this moves into the hands of a financial sponsor.
So who's first in line for that pressure?
The first group will be the large branded consumer staples companies, the ones who rely on huge volumes of packaging.
Can you give us some names?
Sure. We're talking about massive producers like Procter & Gamble, ticker PG, and Kraft Heinz, KHC. They use sealed air materials for everything, not just shipping, but for keeping food fresh, keeping products safe on the shelf.
So what's the risk for a PG or a KHC now that Sealed Air is private equity owned?
Well, private equity has a very specific playbook. It's all about maximizing the return on their investment. To pay down all the debt they just took on to buy the company, they will be absolutely laser focused on expanding margins at Sealed Air.
Which means they look to their customers to find those margins.
Exactly. You can expect much tougher contract negotiations. The new private management at Sealed Air is going to push for price increases that maybe the old public company would have softened. It's about profit maximization now.
But these consumer companies are already fighting inflation on all fronts. If packaging costs go up, what does that do to their bottom line?
Well, if PG and KHC can't pass 100% of those higher costs on to you at the grocery store, and in a competitive environment, they can't always do that. It directly squeezes their margins.
Okay, so that's a new headache for their procurement teams. What about the other huge users of this stuff? The e-commerce and retail giants.
This is maybe even more critical for them. Their entire business model is defined by the speed and, more importantly, the cost of fulfillment.
We're talking about the biggest players in logistics: Amazon, AMZN, and Target, TGT.
When you ship millions and millions of packages every single day, even a tiny increase in the cost of bubble wrap or foam fill has a massive compounding effect.
And a private equity-owned Sealed Air will be looking for those tiny increases everywhere.
You better believe it. They will manage every single contract to optimize price. They know how dependent an Amazon or a Target is on their products.
So they have a lot of leverage in those negotiations.
A ton of leverage. Amazon is fighting a war where profit is measured in fractions of a penny per shipment. Higher material costs go straight to their fulfillment cost line. They can try to engineer new packaging, sure, but that takes time. In the short run, they're vulnerable.
That brings us to the last group facing new challenges: Sealed Air's direct competitors.
The other mid-cap packaging companies. For players like Sunoco Products, that's SON, and Silgan Holdings, SLGN, the competitive landscape just became structurally more difficult.
Why is a private Sealed Air a bigger threat than a public one?
It comes down to scrutiny and timeline. A public company like Sunoco has to report their earnings every quarter.
They live and die by that number.
They do. They can't just decide to lose money for a year to invest in R&D or to aggressively undercut a competitor on a contract. Wall Street would punish their stock immediately.
But a private Sealed Air doesn't have that problem.
None at all. They are completely freed from that pressure. They can restructure, they can make huge investments that hurt earnings for a while, and most critically, they can be incredibly flexible on pricing.
So they could, in theory, bid very low on a contract just to steal market share, knowing their real payday is years away when the private equity firm sells the company.
That's the risk. They're competing against a rival with a much longer, more aggressive game plan. And that means tougher competition for contracts and, potential margin pressure for all those mid-cap rivals over time.
Okay, let's bring this all together. We have a $10.3 billion buyout. It delivers immediate value to Sealed Air's shareholders, and it sends a positive signal to the packaging sector and the banks that finance these deals, like JPM and GS.
But that same deal immediately creates new cost risks for its biggest customers, like PG and Amazon. And at the same time, it intensifies the competitive fight for rivals like SON.
So the final question for you to think about is this. Protective packaging is fundamental to e-commerce, to logistics, to food safety. As more of these core industrial suppliers go private, how does that affect the balance between innovation and just pricing power?
That tension, innovation versus just raising prices, is really going to define this sector for the next few years.
A compelling dynamic to watch as this deal moves forward. Thanks for walking us through all the different angles on this.
Our pleasure.
As always, we must state clearly that this discussion is purely the opinion of the author and is not financial advice, nor is it a recommendation to buy or sell any security mentioned. We are here simply to inform,